America's rich never sell their assets. How should they be taxed? Taxing unrealized capital gains is a contentious issue that is heavily debated these days. President Joe Biden proposed a billionaire minimum income tax, which includes a 25% tax on unrealized capital gains for Americans with over $100 million in assets, aiming to raise $500 billion, 2% of GDP, over a decade. The strategy of buy, borrow, die has come under scrutiny, as it allows the wealthy to avoid income and capital gains taxes. For instance, borrowing $20 million against $100 million worth of equity incurs no tax liability as loan proceeds are not considered income. The stepped-up basis exacerbates this issue. When an asset holder dies, the capital gains assessment value is adjusted to the asset's value at the time of death, potentially eliminating taxes on gains. From 2018 to 2022, securities-backed loans at Morgan Stanley and Bank of America surged from around $80 billion to almost $150 billion. This strategy became riskier with higher interest rates, as most loans at Morgan Stanley have floating rates. By the end of 2023, the value of such loans at both banks had declined. Three main arguments oppose Biden's proposal: it's unfair, unconstitutional, and administratively burdensome. Critics argue that taxing unrealized gains is unfair as asset values can change rapidly, and a 2021 New York University survey found 75% of Americans oppose such taxation. The constitutionality of wealth taxes is debated. The Supreme Court's decision in Moore v. United States upheld a tax without addressing the constitutionality of taxing unrealized gains. Wealth taxes on private assets are seen as unworkable due to administrative complexity. However, there are property taxes, which effectively tax unrealized gains, are common in the U.S., with rates ranging from 0.3% to 2.3%. Over half of the states reassess property values annually. Valuing assets like stocks and bonds is straightforward, but valuing private assets is challenging. The IRS took 12 years to value Michael Jackson's estate, illustrating the potential difficulty. Biden's plan includes measures to mitigate volatility, such as allowing losses in one year to offset gains in another. However, the administrative effort to levy a new tax on a small pool of people and all their assets would be immense. European countries that abandoned wealth taxes often cited administrative costs. An alternative to taxing unrealized gains is eliminating the stepped-up basis, which Biden also supports. This would remove the incentive to buy, borrow, die, and likely avoid legal challenges. Taxing capital gains at death and closing loopholes could raise substantial revenue. This approach is seen as more feasible and less radical while achieving similar goals.